You're welcome to my channel. In this video we are going to be talking about container accounts. Accounting for returnable containers. A container refers to anything in which goods are enclosed or packed. It can be crates, packets, a cylinder, drums, etc. And types of containers, we have two types of containers, and that is returnable containers. An example of returnable containers is crates, and then drums. Then non-returnable containers, those containers that are taken once by the customers and they can never return them. An example we have is cartons, polythene bags, and other things. So under a returnable container, a deposit is charged by the supplier on the container together with the price of the goods, and when the customer returns the container, the deposit is refunded. However, these containers should be returned in good condition to the supplier. Like under returnable containers are those containers that are taken by the customers, but they have to be brought back by the customers. And in case of returnable containers, the customer is charged an extra price for the containers, and that price is refunded when the customer returns the containers, but only when the containers are still in good condition. And under non-returnable containers, the price of the container rate are charged to the customers. In non-returnable, they do not charge the price for the containers. Like if you go to the supermarket and you buy things, they always put for you in a polythene bag, but they do not charge it because they already accounted for it when they were pricing the products. Under non-returnable containers, the price of the container is not charged to the customers. The containers of such items are an integral part of the goods sold, which are charged to the manufacturing account. The price of the containers are already included on the price of the product. Then accounts required for returnable containers. So since returnable containers are returned to the business, we prepare their accounts. But non-returnable containers are taken once and they never return. So we do not prepare accounts for non-returnable containers, but we prepare accounts for returnable containers. So let's look at the accounts required for returnable containers. There are basically two accounts that are opened in the books of the supplier for returnable containers. First is we have the container stock account. Container stock account. This account records the following. It records all the transactions relating to the containers owned by the company. Then it also records all the purchases and sales of containers, including the cost of repairs, containers scrapped and sold. And then it also records the profit and loss on containers transactions during the year. Then lastly, it records the opening and closing balances of containers, both at the premises and with the customers. That is the container stock account. Then the container suspense account. The container suspense account, this records the dealing between the company and the customers, and it records the following. It records the credit back price to customers. We are going to see what it means. It records the charge out price to customers, then the higher profit on containers sent to the customers, then in containers retained by the customers, in containers that the customers didn't bring back. So now let's look at the key terms and the containers accounts. First we have the cost price. Cost price, this is the price at which the company buys the containers. The price at which the company buys the containers from other companies that sell containers. Then charge out price. Charge out price is the value at which containers are given to customers. Yeah, in case you go to buy a soda in that glass bottle, yeah, the soda is 1,000, but they may charge you 1,500, and they tell you in case you bring back this bottle, we shall give you back your extra 500. So that extra 500 is what we call the charge out price, the value at which containers are given to customers. In credit back price, credit back price is the value at which customers are refunded upon the return of the containers. So when you take back that glass bottle, they won't give you exactly 500. They'll give you like 400. Yeah, and that 400 is the credit back price. And then higher profit. Higher profit is the difference between the charge out price and the credit back price. Yeah, they charge the bottle to you at 500, but they give you back 400. So the difference between the two is 100, and that 100 is the higher profit. Then another term is depreciated value. This is the value at which containers are kept for stock taking purposes. Yep. So the container suspense account records the credit back price to the customers, the 400, then the charge out price to customers, the 500, then the higher profit on containers sent to customers, the 100, then in containers retained by customers. Yeah. Now let's look at accounting entries under containers. Accounting entries in respect for returnable containers are made as follows. Charge out price. In case of charge out price, you debit the customer's personal account and you credit the container suspense account. Then, the difference between charge out price and the credit back price of the container, and that is higher profit. You debit the container suspense account and you credit the container stock account. Then credit back price for containers. You debit the container suspense account and you credit the customer's personal account. Then for credit back price for containers retained by customers, we debit the container suspense account and we credit the container stock account. Then 5, the costs of purchase of new containers, we debit the container stock account and we credit the cash or bank account. In the cost of new containers, we debit the container stock account because the stock of containers is increasing. It increases by debiting. Then we credit cash or bank because we are buying the stock using cash, either cash or bank. Then the cost of repairs to containers. When you repair containers, you're making the damaged containers useful. Yeah, so it increases on the stock. So you debit the container stock account. Then when you're repairing, of course, you have to pay money to the person who is repairing. Okay? So you credit cash or bank account. Then in case of cash received from containers damaged and scrapped, yeah, when you sell off damaged containers for cash or bank, so cash or bank will increase, so we debit cash or bank, and the container stock will reduce because you've sold some, so we credit the container stock account. Then in case of a profit on containers on the stock account, we debit the container stock account and we credit the profit or loss account. Yeah. Then